Now we should know the difference between the consolidation and the equity method. Consolidation is for subsidiary, equity method is for investment associate and investment in joint venture. So in the consolidation, everything of the subsidiary will be added together. So each line item in the subsidiary will be added with the parents, and there will be a non-controlling interest showing separately. So under consolidation, the investment accounts will be fully eliminated, and we will substitute with every line item of the assets and liability, and there will be fair value adjustments and the goodwill included in the consolidated financial statements. However, under equity method, we simply share the profit of the associate, and everything will be included only as the investment associate. So we include only our portion, and therefore there will not be any non-controlling interest, because if this is a 30% associate, we only share our own 30%. So in the investment balance will consist of the cost, fair value adjustments, and the goodwill component. So we include our investment associate only as a cost plus any share of post-acquisition change in equity. One thing very important is under consolidation, because we include everything of the subsidiary into our consolidated financial statements, therefore some financial ratios will be very different. Say for example, for return on asset, because we add everything of the subsidiary together with the parent, so the asset figure will be bigger comparing with the equity method, because for the equity method we only share the net assets, so assets minus liability, therefore the asset figure will not be that big, and therefore the return on assets under consolidation will be worsened, because the asset figure will be bigger while the return figure will be the same, no matter this is consolidation or equity method. And also for the debt equity ratios will be worse off as well, because under consolidation, the debt, every liability, every debt of the subsidiary will be added together, but under equity method, we don't add the absolute figure of the debt, we only share our portion of the net asset. Therefore, some ratios like the debt equity ratio will be better under equity method. This is the reason why some companies do not want to consolidate, because if they have to consolidate, we have to add all the liability of the subsidiaries together. This increases the debt, and this increases the risk ratio, and some financial ratio will not be too good. Anyway, we must include everything, because we have to account for the substance. So if this is really a subsidiary, we should account for it as a subsidiary. Let's see a full example for the consolidation with associate. In this case, P is the investor. As at 31st of December 2002, P holds shares in 3 companies. So altogether we have 4 companies here. So P is the investor. We have got subsidiary A, we have got subsidiary B, and then we have got an associate. So for the subsidiary A, this is an 80% subsidiary. For subsidiary B, this is a wholly owned subsidiary. And this is a 30% associate. Because this is an 80% subsidiary A, there will be a non-controlling interest. The question told us that the fair value of the non-controlling interest at the day of acquisition was 1.25 million. For subsidiary B, there's no non-controlling interest because this is a wholly owned subsidiary. But for subsidiary B, we have been told that there has been an excess of fair value over book value. So there is a fair value increment for a building. So this fair value increment will be 600,000. So we can exercise control over SA and SB. Therefore, SA and SB are subsidiary, but we can only exercise significant influence over A. Therefore, A is only an associate. So the book value of the identifiable net asset of subsidiary A and the associate will close to the fair value. Therefore, for subsidiary A and the associate, no fair value adjustments. Goodwill of subsidiary A is 164,000. For subsidiary B, the excess of the purchase consideration was attributable to an undervaluation of building. As we have said before, there has been a fair value adjustment, fair value increment for the building, 600,000, and the remainder was attributable to the goodwill. For this goodwill, it has undergone a impairment. The impairment was 10% of the original goodwill in the first year of the acquisition. And for this fair value adjustment, it should be depreciated over a useful life of 20 years. Not only we have got fair value adjustments, there has been an intercompany transaction. Sales of P during the year to subsidiary A amounting to 300,000. So there's an intra-group sales. There has been a profit element, and the inventory of subsidiary A included some unrealized profits of 30,000 as at 1st of January 2002. So the opening inventory has got a overstatement, unrealized profits. So we have overstated the closing inventory last year, amounting to 30,000, and the overstatement of the inventory for the current year, right, as at the end of the current year, is 25,000. Inventory will normally sold within 1 year, therefore last year's has been realized. We found the tax rate, therefore we have to account for deferred tax implication. This is the financial statement for the 4 companies now on 31st of December 2002. Parent, subsidiary A, subsidiary B, and associate. We found some intercompany transaction because we do have the interest income from subsidiary and associate, and we have paid interest expense to parent. So therefore, we have to adjust for this intra-group and intercompany transaction later. For the statement of financial position, right, we got the statement of financial position for all the 4 companies. Again, we found some intercompany balance or intra-group balance, where loan payable to parents, loan to subsidiary, loan to associate. So we may have to adjust for all this. We first calculate the goodwill for subsidiary A. For subsidiary A, we have got a goodwill. How much? How much we pay? We pay 5 million. And how much we get at the day of acquisitions? We get the equity. That means the net asset. So parent pay 5 million. This is an 80% subsidiary. Non-controlling interest contributed 20%, which is 1.25 million under full goodwill method. So therefore, what we pay is 6.25 million. What we get is 4.2 million. So what we pay minus what we get is goodwill. Goodwill for subsidiary A, 2.05 million. For subsidiary B, this is a wholly owned subsidiary. So the parent pay 100%, 4.6 million. What we pay minus what we get, how much we get? The book value of the net asset was 3.6 million. But not only the book value of the net asset, there has been a fair value adjustment after tax. Remember, there has been a 20% tax rate. So fair value increment after tax. So book value of net asset plus fair value increment after 20% tax rate is 4.08 million. So what we pay minus what we get is goodwill. Goodwill is 520,000. For the associate, there may be a goodwill component, right? So we may calculate goodwill component, which is incidentally 0. Anyway, we calculate the goodwill. Thereafter, we adjust for the consolidation adjustments. For subsidiary A, we credit investment in subsidiary A 5 million. We credit non-controlling interest 1.25 million. This is what we pay. What we get at the day of acquisitions was share capital and the retained earnings. Therefore, we debit away the share capital and we debit away the retained earnings at the day of acquisition. This is what we get. So what we pay minus what we get is goodwill. So goodwill is a balancing figure, exactly matched with our calculation. We do the same for the subsidiary B. So we credit investment in subsidiary B, 4.6 million. This is what we pay, 4.6 million. There's no NCI. This is a wholly owned subsidiary. What we get at the day of acquisition is share capital and the retained earnings. We don't have any other reserves. So we simply debit share capital and we debit retained earnings at the day of acquisition. This is the book value of the net asset. After the book value of the net asset, we have got a fair value increment. Fair value increment is 600,000. After tax, tax is the deferred tax liability, 20% tax rate. So this is what we get. What we pay minus what we get is goodwill. Goodwill is 520,000, the same as what we have calculated. For subsidiary B, we have got a fair value increment. For both companies, there has been goodwill impairment. Subsidiary A have got a goodwill impairment, 164,000 in 2001. 2001 is last year because now it is 2002 already. Therefore, this is last year's impairment, so we debit retained earnings. But subsidiary A is only an 80% subsidiary. If we simply debit retained earnings 100%, we ask the parent to share all the adjustments. So therefore, only 80% to parent, right? Because this is a 80% subsidiary, 20% goes to NCI. So this represents the goodwill impairments last year. So we credit goodwill 164,000. For subsidiary B, the impairment is 10% of the original goodwill. Original goodwill was 520,000, 10% impairment. This is a current year impairment. Therefore, we debit impairment loss, profit and loss, and we credit goodwill. Now we come to the amortization of the fair value adjustments. Higher fair value, higher depreciations. The fair value increment was 600,000 to be depreciated over 20 years. So 600,000 depreciated over 20 years. This means 30,000 every year. This is just the first year of the acquisition, so therefore only 1 year. So we debit depreciations and credit accumulated depreciation. When we create these fair value adjustments for the building, we have got a deferred tax liability. Now we are gradually reversing, right? We are gradually using this building. Therefore, we have to reverse this deferred tax liability gradually, 20% tax rate. So therefore, when we debit depreciations, we credit tax expense, 20%. When we credit accumulated depreciations, we debit away part of the deferred tax liability, 20% tax rate. After we do the fair value adjustments, amortization, additional depreciations, we find one intra-group transaction. Sales of parent include 300,000 intra-group sales. Therefore, we have to debit sales 300,000 and we credit cost of goods sold 300,000. This is for the current year intra-group transaction. And for this current year intra-group transaction, there has been 25,000 overstatement of the inventory at the end of the year. Therefore, we credit inventory because the inventory has been overstated. We credit inventory 25,000 and we debit cost of sales 25,000. You can combine these two journal entries into one as usual. Because you credit inventory, you have to debit the deferred tax asset, 20% tax rate. Because you debit cost of goods sold, you have to credit tax expense, 20% tax rate. But don't forget that we got opening inventory also overstated. So last year, you must have debited cost of goods sold and credited inventory. to repeat this journal entry, last year it was a cost of goods sold. This year we debit retained earning. Last year it is a inventory. This year, if we simply credit, we will have to credit inventory. But we understand that last year's closing inventory must have been sold already. So we know that all this inventory has been realized. So we don't credit inventory and debit inventory. Instead, we debit retained earnings and credit cost of goods sold. Because you credit cost of goods sold, we debit tax expense, 20% tax rate. Because you debit retained earnings, we credit retained earnings, 20% tax rate. Not only we have got this intra-group sales of inventory, we have got other intra-group transactions as well. In the financial statement, we found the interest income from subsidiary and associate. So intra-group transaction between the parent and the subsidiary should be eliminated. Remember, we eliminate only for subsidiary. For associate, we are not going to consolidate the figures for the associate, so nothing for you to eliminate. So therefore, we eliminate only between parent and subsidiary. In the subsidiary A, 20,000. In the subsidiary B, 15,000. So they are being charged with the interest expense. Therefore, now we credit away interest expense as if there's no such transaction at all, because this is an intra-group transaction. So we credit away the interest expense that subsidiary A and B have recorded, and we debit away the interest income that the parent has recorded. We eliminate only among parent and subsidiary. We eliminate also intra-group balances. So again, we eliminate only between parent and subsidiary because we are not going to consolidate the associate. Anything of this will not be included in our consolidated financial statements. So therefore, the associates figures will not be eliminated because we did not include it in our consolidated financial statement anyway. So in the subsidiaries book, you find loan payable 450,000 and 400,000. So loan payable is a credit. Therefore, to eliminate means we have to debit away the loan payable. In the parent's own book, they have got a loan to subsidiary. This is a loan receivable. To eliminate, we credit loan receivable. Not only we have got a loan balance, we have got a dividend balance as well. In the subsidiaries A's book, you find dividend payable. In the subsidiaries book, B's book, you also find dividend payable. Subsidiary A is only a 80% subsidiary, so only 80% of this 50,000 is the dividend payable to parent. So we eliminate only for 80%. The 20% dividend payable to NCI will remain. Dividend payable to NCI is a real liability. It should not be eliminated. So we eliminate only between parent and subsidiary. Therefore, 80% of this 50,000 is 40,000 together with 30,000 for the subsidiary B. We debit dividend payable that subsidiary A and B has recorded, and we credit dividend receivable from subsidiary that the parent has recorded. Therefore, we debit dividend payable and we credit dividend receivable. This is 70,000 because only 80% of the 50,000 subsidiary to parent should be eliminated. We also find that the subsidiaries has paid out dividend. Why? Subsidiary has paid out dividend in the current year. So whenever the subsidiary pay out dividend in the current year, we have to eliminate. Subsidiary A is only a 80% subsidiary. So 80% of the 210,000 goes to parent together with 100% of this 70,000. So in the parent's own book, they must have recorded this dividend income amounting to 80% of the 210,000 together with the 70,000 from the subsidiary B. So we debit away the dividend income that the parent has recorded Out of this 210,000, 20% goes to NCI. Therefore, we debit NCI 20% of the 210,000. Altogether, we credit dividend declare 280,000 because 210 from subsidiary A and 70 from subsidiary B. We eliminated the dividends. Now we share the profit. We share the profits from the day of acquisitions up to the beginning of the current years to NCI. So for subsidiary A, only subsidiary A has got non-controlling interest because subsidiary B is 100%. So at the day of acquisition, the retained earning was 2.2 million. At the beginning of the current year, subsidiary A have got a retained earnings, opening retained earnings 4 million. So from the day of acquisitions up to the beginning of the current year, the increase in retained earnings is 1.8 million, out of which NCI can share 20%. Therefore, we debit retained earnings and credit NCI 20% of the profit from the day of acquisitions up to the beginning of the current year. Now we share the current year profit. The current year profit after tax of subsidiary A. So again, only subsidiary A have got non-controlling interest. So profit after tax of the subsidiary A is 589,000, out of which 20% can be shared to NCI. So we debit profit to NCI, 20% of the current year profit after tax, and we credit NCI. This is for the subsidiary. We have got 2 subsidiaries, but in addition, we will have an associate. So we share the profit of this associate. From the question, we have been told that this associate for the current year have got 654,400. We acquired this associate only in the current year, therefore only 1 year profit. 654,400. We share 30%, therefore we debit investment associate and we credit share of profit of associate for the current year. When we share the profit, we notice that this associate actually has paid out dividend. Dividend only come from profit because we share the profit already, and the dividend income from associate should not be regarded as a second source of profit. Therefore, we eliminate our portion. So the associate has paid out 140,000, out of which we must have received the 30%. So in the parent's own book, they must have recorded a dividend income, 30% of the 140,000. Now we debit away this dividend income and we credit investment associate. So we receive the dividend income, so the balance for the investment associate should go down. We have prepared many journal entry already, so now we have to input it into our consolidated financial statements. So first of all, we put everything of the parent and everything of the subsidiaries here. Strictly speaking, we don't need to put these associates columns here because associate will not be consolidated. Associate will not be consolidated. Therefore, say for example, for the bank loan, right? So we include only parent and subsidiary. So therefore 565,000 plus 105,750 plus 171,250 is this 842,000. We don't add the associates figures together. So strictly speaking, no need to add this column, the yellow column, no need to copy here. So we input all the consolidation adjustments here, and therefore we have got the consolidated balance sheet. Something that we have to notice, the first thing is the consolidated share capital is always the same as the parent's share capital. Non-controlling interest should be inserted before we total for the total equity. For some items, say for example, dividend payable, right? So only 80%, that means 40,000 of this has been eliminated. As we have said before, dividend payable to NCI will not be eliminated. Therefore, the dividend payable, actually this 110,000 included two elements. One is the dividend payable by the parent, and one is the dividend payable by subsidiary to NCI. The 20% of this 50,000 remains. This is the dividend payable to NCI. Something like the loans to associate remains. Right? We eliminate only parent and subsidiary, and the balance with the associate will remain. So loan to associate remains because we did not consolidate the associate. Therefore, there's no such 120,000 to be offset with this loan to associate. Also, dividend receivable from associate, this 12,000 will remain because we do not consolidate associate, so we have nothing to eliminate against with this dividend receivable from associate. Not only we have got the consolidated balance sheet, we have got the consolidated statement of comprehensive income and retained earnings. So strictly speaking, this is all the profit and loss items and the retained earnings. Consolidation adjustments included here. Right? Strictly speaking, if we are going to prepare both the balance sheet and this consolidated statement of comprehensive income and retained earnings, you don't need to repeat this journal entry twice. You just input it here, and then you can copy this 10,070,420 into our consolidated balance sheet. Right here, we included this consolidation adjustments. We post it twice, assuming that we are not going to prepare this consolidated balance sheet and consolidated statement of comprehensive income and retained earnings together. Right? If we prepare only this consolidation worksheet, then of course you have to put it here. If you prepare both, so you can just post it here and you copy this to your balance sheet. Okay, so in our consolidated balance sheet, we found the non-controlling interest here, and we found the investment associate, which is 1,954,320. As I've said before, the investment associate and non-controlling interest, these two figures can always be analyzed into its three components. The investment associate first, we have got three components: book value of net assets, fair value adjustments, and the goodwill component. Right? For this particular example, there's no fair value adjustments and there's no goodwill component as we have calculated. So only share of book value. How much is the book value? From the question, we know that the total equity, or you can calculate the same using assets minus liability, is 6,514,400. So therefore, 30% share of the book value of the net asset is exactly the same as what we have calculated here, investment associate. The same for the non-controlling interest. This non-controlling interest can be analyzed into its three components. The three components are the book value of net assets, fair value adjustments, and the goodwill component. Book value of the net asset, 6,379,000, 6,379,000. So that's why we just copy this. 20% non-controlling interest can share this book value of net asset. There has been no fair value adjustments. The last component is the goodwill component for the NCI. So we have to calculate the goodwill for NCI separately. It is not a proportionate share of the total goodwill. So how much is the goodwill for NCI? Long time ago, we should have calculated. Goodwill is what NCI pay, which is the fair value of the NCI at the day of acquisition, minus what NCI gets at the day of acquisition. NCI pay 1,250,000. They get 20% of the book value of the net asset. So this is the goodwill component. This is for subsidiary A. Subsidiary A have got a impairment of goodwill, for which 32,800 has been allocated for NCI. Therefore, the closing balance, the remaining balance of the goodwill for NCI should be originally 410,000 minus the goodwill impairments, so the remaining portion 377,200. When we add them together, exactly we match with the consolidated balance sheet.